Bismillahirrahmanirrahim. Welcome to Financial Appraisal. In this video, we will learn what is project appraisal, different types of appraisals, what is financial appraisal and why we do financial appraisal, different financial terms, financial appraisal methods, that is NPV, IRR and BCR. Now, what is project appraisal? Basically, project appraisal is a detailed and thorough evaluation process that aims to assess the feasibility of the project, viability, and potential of the project or investment which are going to do. Now, there are different types of appraisals. First one is technical appraisal. Second one is social and environmental appraisals. Third one is economic and financial appraisal. This will be discussed in detail in this video. And the last one is organizational or management appraisals. Now, why we do financial appraisals? To check the financial soundness of the project, the incremental financial benefits and costs involved in the project, what will be the discounted rate, cash flow, discounted cash flow, to calculate the time value of money involved in that investment or the project, the costs and benefits which are required at different times, different points of the project life cycle. And we do financial appraisals to calculate the present values of all the benefits and costs involved in that project. Now, there are two financial terms which are used again and again in financial appraisal. First one is time value of money. Basically, time value of money, the money available at present time is worth more than the same amount in future. The reason is that the money has potential earning capacity. What is discount rate? Discount rate basically is used to convert the cost of the projects and the benefits of the projects in present value. Discount rate is calculated on the basis of following three terms. First one is the prevailing social rate of time preferences, the opportunity cost of the capital which is involved in that project, then weighted average method. In Pakistan, the recommended discounted rate is taken as 12.5%. Different methods in financial appraisals. One is NPV, net present value. Second one is internal rate of return method. And last one is benefit cost ratio. These three methods are used in financial appraisals. What is NPV? Net present value. Basically, it is a tool, a method or technique. The difference between present value of cash inflows and the present value of cash outflows over a period of a time. How can we calculate NPV? Here is given a formula, that is NPV is equal to cash flow over 1 plus I T minus initial investment, where I is the discounted rate which is used in the formula, that may be 10%, 12.5%, or in the circumstances which are given in that project. And the time basically is the number of periods, number of years for which the project is going to be done. Now, what are the usages of NPV? Basically, NPV is used in capital budgeting and investment. For what? To analyze the profitability of that investment or the project. Second one, it takes into consideration the time value of money. Mean we calculate the time value of investment and its benefit. NPV is also used to calculate the present value of future in cash flows, future inflows in that project. NPV is also helps to financial experts to make better business decisions about investment opportunities. Now, there are three values of NPV. NPV may be positive, NPV may be 0, or NPV may be negative. If the value of NPV is positive, it will indicate the investment is profitable. The business, the investment which are going to do will give us profit. We will carry on this project. But if the NPV is 0, it means the present value of investment and present value of return will be same. There will be no profit and loss. Rate of return will be equal to discount rate. So no profit, no loss in that investment. But if the NPV is negative, it indicates that the project or investment which are going to do is unprofitable. It will go in negative terms. The expected cost overweight the earnings, mean earning will be less and cost will be more, and there will be financial loss in this project. So we discourage to that project. That investment should not be considered. Basically, the value of NPV higher is preferable. There are different advantages of NPV. Basically, NPV is more realistic and accurate than other methods, mean IR or BCR. Second one is it considers the time value of money and discounted cash flow. Third one, returns a single dollar value that is relatively easy to interpret. We can easily understand it. NPV also considers the risks and opportunities of future cash flows by using a discounted rate. mean what kind of risks and opportunities, uncertainties will be involved. NPV can also help us to compare different projects with different sizes, duration, and cash flow patterns. It's easy to compare those projects with each other. But here are some limitations to use the NPV, such as, and to calculate the NPV, it majorly relies on inputs, estimates, and long-term project, and it is calculated for long-term projects, projections. It does not consider project size, return or on investment. It's somewhat hard to calculate manually, especially for those projects which are expanded on many years cash flow. NPV is driven by quantitative inputs. It does not consider non-financial benefits. NPV requires a lot of assumptions and estimates which may not be reliable or accurate, such as the prevailing market conditions now and after that, the demand, competition in the market, costs, regulations, etc. Sixth one is NPV may also be sensitive to change in these assumptions and estimates, which may affect the decision making process. Mean if assumption is changing, then the value of NPV would also be changed. NPV not capture the strategic or qualitative aspects of the project, such as the impact of the reputation of the firm, its brand name, customer satisfaction, their loyalty, social responsibility. And the last one is NPV ignores the flexibility and opportunity of the projects, mean investment, such as to expand the project, to contract, delay, or abandon in case of changing conditions, environments. NPV ignores all these aspects. The remaining IRR and BCR will be discussed in the second part of financial appraisals. Thank you.